Well, a very good morning to those of you joining us for the first time, and welcome back to those that were at the previous session. For those that don't know me, I'm James Fudge. I'm Head of Events at the MTA, and I'm here to welcome you to our next session. For those of you who weren't at the last session, just to point out on the right-hand side of your screen, you can add questions throughout the presentation. What we will do at the end is I'll then relay those to Rhys and get as many answered as we can in the time. So I'm going to now introduce you to Rhys Herbert, who is the Senior Economist in the Research Department at Lloyds Bank Commercial Banking. He's responsible for analysing and forecasting trends in the UK and other major economies with a special interest in the manufacturing sector. Rhys joined Lloyds Bank in January 2011, having previously worked at economics consultancy Oxford Economics, where he headed up its industry forecasting service. I will now, thankfully for all of you, disappear off your screen and hand over to Rhys. Rhys, over to you.
Okay, thanks very much, James, and welcome everybody. Thanks very much for joining us. I will now talk about the economy for the next 20 minutes to half an hour. What I'm planning to do is talk to you, is do four things really. First of all, I want to talk about recent developments and what's happened to both the global economy, but more specifically the UK economy, and in particular manufacturing over the last 12 months or so. Then I just want to talk briefly about what's happening in financial markets, because I think there's some interesting developments there that are relevant for you. Then I'll talk about the economic policy side, what's happened to monetary policy and fiscal policy. There's a few things that I want to emphasize there that are important for you to watch out for, because they could have an impact on you in coming months. And then lastly, I'll talk about what will happen next in the economy, or at least what could happen next in the economy. Obviously, things are very uncertain now, but I want to try and point to a few factors. Now, obviously, a lot of this will be dominated by the impact of the pandemic. I seem to have gone from a situation where I give presentations that are dominated by Brexit to a situation over the last 10 months that are completely dominated by the pandemic. But I will try and talk about other things as well and point to other key issues as well. So first of all, what's been happening to the global economy? Well, what's been true of the UK has been true globally as well. There's been a big hit to global economic growth as a result of the pandemic. It started in China, as you know, and as a result, China was the first area that saw a big hit to economic growth. It started there in January or February of last year, but through March and April, it spread around the world. So basically what we've seen so far has been three stages. In the first stage, essentially through March and April of last year, we saw a huge hit to output in most economies as things were shut down in a lot of economies in order to try and get the pandemic under control. Then we saw a gradual rebound through the late spring and the summer months as some restrictions were gradually eased. And then more latterly, we've seen another slowdown and in some cases a stalling or even fall in activity as the COVID-19 cases have accelerated again going into the winter months. So, a similar pattern everywhere. A couple of things that I would note in terms of differentiating over time is that during the first lockdown, we saw big falls in activity across sectors, with service sectors and manufacturing both falling sharply. You can see there on the left-hand side of the screen, I've got some measures of manufacturing activity, and there was a huge dip in manufacturing during the spring of last year. In the more latterly, in the present downturn, though, there's more of a distinction between a service sector, which again has been hit hard by social distancing restrictions, and manufacturing and construction that are less directly affected, but have continued to, and as a result, have continued to grow. And I want to explore that a bit more in a moment. I would also make a distinction between China and a lot of the rest of the global economy right now. Despite the fact that the pandemic started in China and initially the Chinese economy was hit hard, the China economy has sort of rebounded much more quickly than other economies. It's already past its previous peak in terms of economic activity, and so far at least there's far less sign of a renewed downturn in China. So a sort of a relatively good performance there. Now let's turn and talk in a bit more detail about what's been happening in the UK. First of all, I just thought I'd show you what's been happening to the GDP numbers in detail. Again, this shows a similar picture to the UK as happened in other economies. A big fall in output during March and April of last year. And that was across the board, not only in service sector activities, but also you can see huge falls in activity in construction and manufacturing. And then through the sort of May period on through to about September, a recovery in output, initially particularly strong in construction and manufacturing, where restrictions were eased first, but also increasingly through services as well. And then more latterly, you can see we've had another fall in GDP in November, which are the last available figures right now. But manufacturing activity and construction activity have held up far better this time. Now, November's the last official data we have. As of November, GDP is around about 8% below where it was before the pandemic. So, despite the sort of summer recovery, the level of activity is still relatively low in the UK, but it varies a lot by sector. Service activity is still more than 10% below where it was before the pandemic, and if you look at some parts of the service sector, activity is much more than that below where it was before prior to February. In contrast, construction activity is actually above where it was before the pandemic hit, and manufacturing activity is now only around about just over 4% below what it was prior to the pandemic. Though, of course, within manufacturing, there are big variations, and I'll talk about those variations in a moment. So that was the situation through November. We don't have any sort of official data so far past November, but we do have unofficial business surveys, including what are called the Purchasing Manager surveys. And what those suggest is that the economy as a whole clearly remains under pressure. We did see a little bit of a rebound in activity in December when social distances measures were sort of temporarily relieved. But it does appear that activity turned down again through January. There continues to be this distinction between the manufacturing and construction sector and what's going on in services. On the manufacturing side, it looks like activity was supported in November and December by some pre-Brexit sort of preparations. There was stock building at home, and so a front-end loading of exports to the Eurozone in order to sort of preempt the new regulations and the possibility of a no-deal Brexit. So we probably saw a boost to manufacturing activity in December, and that probably suggests that there's been some payback in January, post the Brexit deal. But overall, the sort of outlook for manufacturing, while by no means great, given current constrictions, does look somewhat better for services, so you can at least comfort yourself with that. Now, just looking at slightly more detail of what's been happening to the manufacturing sector, there's clearly a lot of things, distinctions across the manufacturing sector, with some bits hit a lot harder, at least by the initial spring slowdown, than other bits of the economy. You can see in particular that there was a huge fall in motor vehicle production during that spring lockdown, when a lot of factories were closed there. Similarly, aerospace, which is normally an outperformer in the UK economy, saw a very sharp slowdown in activity during those months. In contrast, other bits of the economy, such as food and beverages and pharmaceuticals as well, were less hard hit. Now, we have seen over the summer months, quite a strong rebound in some of these sectors, such as motor vehicles and aerospace. But as you can see, they still haven't got back to their levels of February pre the lockdown. And obviously there continues to be issues about demand in these sectors. The aerospace sector, there's clearly concerns about what's happened to the global air services industry as a result of the lockdown, and that's got real implications for the aerospace sector. And in addition, UK aerospace, there's concerns about what the implications of Brexit are, and the sort of implications of that for a key customer for the UK aerospace industry, Airbus. So tremendous variation by parts of UK manufacturing, but overall, as I said before, manufacturing doing better than large parts of the economy. So that's what's happening on the output side. Before we move on, I just want to point out two other things that's been going on with the economy. First of all, what's happening with the labour market and unemployment. We have seen a rise in UK unemployment due over the last 12 months in response to the recession in the economy. The UK unemployment rate has gone from below 4% to currently be around about 5%. We had numbers out today for November which show the unemployment rate at 5%. So it has been edging up. But you can see here, and I've put in a comparison with the US economy, UK unemployment's gone up by far less than in the US, and that's really courtesy of the furlough scheme, which has prevented a much bigger layoff in UK workers. But a key question, obviously, looking forward, is what happens when the furlough scheme is run down? Will the economy be strong enough then to support all these workers, or could we see a rise in unemployment later this year? The other thing I wanted to point out is how low inflation has been of late. Inflation at one point slipped to almost zero. It was up a little bit this month, but it's still only about 0.6% year on year, which is well below the government's 2% inflation target. We will probably see an acceleration in inflation in coming months. In April, we will see an end to a sort of temporary reduction in VAT in the hospitality sector, which will boost prices. It's also likely that we will see a rise in energy prices in April when Ofsted changes its cap. And there's also been other rises in input prices of late, which point to rise in inflation. So, we could see higher inflation numbers ahead, but inflation is still likely to remain relatively low. So, the emphasis of the Bank of England is likely to be on trying to, get growth going again, rather than being worried about high inflation. So that's what's been happening in the economy, first of all. One factor I think, is worth talking about, at least briefly, is where next on Brexit. As you know, that we did reach an agreement on trade with the EU late last year, which has meant the tariffs on trading goods were avoided. But there are now still non-tariff barriers as a result of us leaving the EU, and in particular, there's extra paperwork, and this is already having a not insignificant impact on the UK economy. The full impact of them will only become clear over time. We are certainly getting initial anecdotal reports about bottlenecks at ports, and in particular, issues with any sectors with perishable sort of trade flows and delays there. In general, the level of trade flow through ports during January has been well below normal. And that's probably because lots of firms stockpiled back in November, December in the anticipation of initial restrictions. So I think we'll only find out really as trade flows go back more to normal in January, in February and March, just how much of a barrier these sort of non-tariff restrictions are. Hopefully firms over time will learn to sort of cope with the extra paperwork and these restrictions, but it sort of is an issue. There's also likely to be further negotiations over the next few years because the deal doesn't cover services or most of services. So it's an issue for the financial sector as well, but I'll leave that for now because it's of less concern for the manufacturing sector. What I'd also say is governments are likely to press forward with negotiating trade deals with other countries as well. So that's what's happening on the with the real economy. What's happening in financial markets? Well, it's been very much a game of two halves with the response to the pandemic, though I'd have to say they're sort of fairly uneven halves. In the very early days of the pandemic, you saw near panic in financial markets. So you saw big falls in equity markets, and you saw a big slide in sterling. What I've put on here is two charts for sterling. The one on the left-hand side shows the longer picture back far as the Brexit referendum of a few years ago, and even beyond that. On the right-hand side, you can see what's happened in the more recent period to the sterling against the dollar and the euro. Now we saw a big slide in sterling in February and March. Since then, we've seen a rebound in sterling, in particular against a very weak dollar. So sterling's pretty much got back to where it was against the dollar, and actually above where it was the dollar prior to the pandemic, though it's still well below where it was before the Brexit referendum. In contrast, against the euro, sterling's still quite a lot lower than it was at the start of last year. Though we have seen a further rise of late after the Brexit deal. Now, just to move on and talk next about what's been happening on the policy front. There's some key developments here. The emphasis over the last 10 months has been very much on supporting the UK economy and the global economy through this very difficult period. So what we've seen is a similar response for governments around the world, using both monetary policy and fiscal policy to support the economy. In the terms of monetary policy, that's meant cuts in interest rates where they can cut interest rates, but interest rates in a lot of economies were already very low. And in case of some areas like the Eurozone, they were in negative territory. So there was only so much that could be done in terms of cutting interest rates. So there's also been an emphasis on alternative policy tools as well. So that includes asset purchases, or this QE stuff you'll have heard about in the press, which is basically a fancy way of getting liquidity into financial markets, and so hopefully into the real economy. And also there's been sort of various lending schemes from central banks around the world. There's also been a massive increase in fiscal policy as well as governments offer to support both to businesses and households. A key part of the UK strategy, as I've mentioned before, has been the furlough scheme, but there's been various other schemes as well introduced. As a result of that, there's been a massive rise in government borrowing around the world, and correspondingly a massive rise in government deficits and government debt levels. And a key question going forward is what happens with regard to these. Now, what happens next on the policy side will obviously depend very much on how quickly we can get out of the current restrictions, which very much depends on things like the vaccine rollout and getting COVID-19 under control. But there's a couple of things to watch for on the policy side. Firstly, with regard to monetary policy, a big issue right now is, will UK interest rates fall into negative territory? I showed in one of the earlier graphs that Eurozone interest rates have been below zero actually for some years, but in contrast, UK and US interest rates, at least policy interest rates, continue to be incredibly low, but above zero. There has been talk about cutting interest rates in both places into negative territory. The US equivalent of the Bank of England has pretty much ruled that out. But the Bank of England has been more ambiguous on this. It has pointed to constraints in this area, and particularly the possible negative impact on the financial sector, but it's not ruled it out. We will get a further report on this from the Bank of England next week, which is well worth keeping an eye on. We suspect that they won't move interest rates into negative territory, but it's certainly something that can't be ruled out, and so it's a possibility that's worth keeping an eye on. Does that mean if policy interest rates fall into negative territory, you will see negative interest rates on deposits? Almost certainly not, but we do wait for some clarification on exactly how it would work, and so that's something worth keeping an eye on. At the very least, what you can expect is interest rates staying very low for a long period of time. The other thing to keep an eye on is what happens next with fiscal policy. As I've mentioned, there's been a huge rise in government deficits, and central governments will eventually want to do something about this. We've got a budget on March the 3rd, and the Chancellor may talk about some of his intentions for fiscal policy ahead. In particular, there's been some reports in the media that he might talk about the possibilities of future tax rises, and in particular a rise in corporation tax. We don't think that we're talking about an immediate tightening in fiscal policy. We would have thought the government will want to be reassured that the economy is very much in recovery mode before it starts to tighten fiscal policy. But it's clearly an issue about what happens with this. We expect them to proceed very slowly and hope that a stronger economy helps to repair some of the damage to the budget deficit, but we certainly can't rule out the possibility of some tax rises and future cutbacks in government spending. Okay, so that's what's happened so far. What happens next? Well, I'm afraid this is where we come in to the area of extreme uncertainty. Obviously a key thing here is the rollout of the vaccine. We have had some positive news, at least for the UK, in terms of the vaccine rollout getting underway, and some signs that things are gathering pace. As a result, there's a lot of hope, not only in the UK, but around the world, that economic conditions will get better through the spring and in the summer, and the second half of the year will look considerably better than the last 12 months, and hopefully things will gather pace through the end of the year and into next year. What I've shown you here is a sort of consensus forecasts for what's going to happen to economic activity over the next couple of years. You can see there what they show is year-on-year growth in output for the world as a whole, and for some of the key areas, including the UK. You can see the huge falls in economic output in 2020, and expectations of a recovery in 2021, 2022. I think most people, including ourselves, are hoping that we will start to see a easing of restrictions through March and April that'll gather pace through the summer months, and so hopefully by the middle of the year and certainly into this the third quarter, we will see things back much closer to normal, and that as a in terms of an easing of restrictions, and as a result, economic developments will look a lot better. But there's obviously a lot of uncertainty around this, and as a result, what I thought I'd give you is a sort of checklist for recovery and things to keep an eye on. First of all, I sort of point to the timetable for easing of lockdown measures. The quickly, that's obviously going to depend on the vaccine rollout, but the quicker things are eased, the quicker we will get back to more normal levels of activity. The second thing to keep an eye on is just how much damage has been done to the economy as a result of lockdown. So, just how much businesses have gone out of business as a result of the sort of restrictions of the last 12 months or so. Third thing to keep an eye on is just how many restrictions continue to be left in place through the sort of easing of restrictions. And so, whether a lot of businesses will need to continue to operate with a lot of constraints put on them, so if things are different from normal. The fourth thing to keep an eye on is the extent of the rise in unemployment as furlough measures are eased. I can't emphasize too much how much of an uncertainty this is for the economy, and whether when we eventually see a sort of a moving in a removal of these furlough measures, will employers feel strong enough to keep their workers on? And finally, will a lack of confidence stop consumers and businesses from spending? So a number of things to look for there. I thought I'd just finish by looking at some of the indicators for different parts of the economy. So again, I would make a distinction between what's happening to consumer spending and some other parts of the economy. Now, during the initial easing of lockdown measures, we saw an even rebounding in spending in different parts of the economy. Consumers seemed relatively happy to go back to spending relatively quickly in the summer and spring as things eased up again. And so, we saw a decent rebound in consumer spending, particularly for goods, but also for services to a certain extent as well. A big question is whether things we'll see a similar pattern this time round. There's already been some improvement in consumer confidence as a result of the vaccine rollout, but consumer confidence remains relatively low. A big question, as I've said before, is to what extent we see a rise in unemployment as a result of the furlough scheme. The other thing to keep an eye on is what happens to pay deals over the next 12 months or so. And will employers feel strong enough in order to offer enough pay so that real disposable income continues to rise? A clear change in trend in consumer spending is the amount of spending that's going on over the internet. And I thought this was a key theme that I should highlight to you. For the several years, we've seen a rising trend in terms of the percentage of sales, particularly of goods, but also services as well, that are done over the internet rather than in shops. And obviously this has surged during the lockdown period. As a result, now close to a third of all retail sales are done over the internet, and in some cases a lot higher. This will continue, I think, to be a key theme going forward, even as shopping centres start to open again. So that's what's happening on the consumer front. Now, on the business front, businesses were much more reluctant to start spending again when the initial lockdown phase was eased, and I think that's likely to continue to be the case as the sort of present lockdown is eased. Business confidence remains relatively low. Our Lloyds Business Barometer has shown some improvement in confidence, but overall, confidence remains relatively low, and that's reflected in things like investment intentions. You know, what we've clearly seen I've seen in the UK for the last few years is that businesses have been very reluctant to invest, particularly to invest to expand capacity, and that's likely to continue to be the case given the constraints on businesses right now. So I would expect investment growth to remain very weak for at least the next few years, and this raises issues for productivity and things going forward. So issues there. In terms of the orders picture for businesses, right now that remains mixed. There's been some modest improvement in manufacturing orders of late, but you know, orders, not surprisingly, remain relatively low right now, and that includes export orders. And obviously, a key issue going forward is to what extent has trade with the EU been impaired by the movement out of the EU, and whether we will be able to find alternative markets elsewhere. So overall, and one final thing I would sort of emphasize is that there's going to be a continued focus on climate change policy and sort of reaction to that. Despite the other things that governments have got on their mind right now, they've continued to emphasize the importance of policies aimed at combating climate change. We should have an important intergovernmental conference in the UK later this year that looks at the next stage of climate change policy, and I'm afraid, you know, this is not something that's not going to go away. It obviously offers opportunities for business, but also it offers constraints as well. So I think I've given you a number of things there to provide food for thought. I think I'll stop there. Just to summarise what I've talked about, there was an initial rebound from the spring lockdown that was actually V-shaped, at least initially, particularly for the manufacturing sector. And you know, it is the case that the manufacturing sector does look in better shape now than it did, you know, back in the early summer of last year. But obviously, there are key questions out there. More sectors, including a lot of manufacturing, of course, are still well below the sort of pre-pandemic level. That was certainly the case with the last set of GDP numbers, which we got in November. I'm sorry, it says October there, but it's actually November. But it's likely that even, you know, now the level of activity is below what it was back in February. The rebound was slowing even before the second set of lockdowns in November, and output is now falling again. We might have seen a sort of short-term rebound in output in early December, but you know, the thing is, right now the economy as a whole is probably shrinking again, though that isn't necessarily the case for manufacturing and construction. In terms of what happens next, obviously a key thing is the vaccine rollout. It does hold out hope that things could get better this year. The timing and pace of recovery is uncertain, but there are reasons for optimism. And I would like to end on a note of optimism. I know we're all worried about the situation right now, with, you know, there's constraints on all of our businesses. But look, what I would say is that, you know, this is a very different recession than usual. Recessions are normally about underlying problems in the economy, and those underlying problems, you know, normally take time to go away. In this case, though, it clearly wasn't. The recession wasn't about an underlying problem in the economy. It was about the pandemic. So if we can get the pandemic under control by the vaccine rollout and so on, that does improve things significantly. Doesn't solve all our problems. You know, there will be lingering effects of the pandemic, and there's obviously other issues out there, including the sort of the lingering impact of Brexit. But things will look a lot better with when the vaccine rollout is in place. So hopefully we can look better forward to a much better situation later this year and into next year. But I would counsel against that background. And a key question then will be how quickly will monetary and fiscal policy be tightened. In particular, watch out for sort of any announcements in terms of government plans as to what they intend to do next. So I'll leave it there, and hopefully there's still some time left for questions.
Rhys, thank you very much for that. That's very much appreciated. Yeah, hopefully you can hear me again.
Yes, I can hear you.
Good stuff. So yeah, there's a few people coming through with questions just asking about, are the slides available? This session is being recorded, so if you've missed out on any of the parts of this presentation, you will be able to access it again afterwards, and we'll be sending the link out. Just a reminder, if anyone's got any questions, or any more questions, there is the question box on the right-hand side where you can enter questions in. We've had a couple through. One of the things that came through a couple of slides ago said, why do you think the UK recovery should outperform everyone except China?
Well, just to go back to the slides there. Well, I'm not sure. You're quite right. People are a little bit more optimistic on the UK recovery, certainly by 2022 rather than 2021. Near term, I think the recovery is going to be about speed of rollout. So in terms of timing of the recovery, the sort of the time of the vaccine rollout and the sort of how quickly we can ease restrictions will make a lot of difference to sort of near-term relative economic performance. So, there's a positive there for the UK in that we seem to be ahead of the Eurozone in terms of sort of turnaround there, and hopefully as a result, the sort of there will be a sort of a positive hit there. In terms of the longer-term picture, though, it isn't just going to be about the vaccine rollout. It's going to be, how we perform, longer after that. I think part of the reason that the UK economy is sort of seen as sort of recovering, more quickly by more over the next 2 years than other sectors is the hit to the UK economy has been more than other sectors. You can see the black line there, the black box there. We've seen a big hit to output everywhere, but the hit to the UK economies has sort of been sort of larger than elsewhere. Now, a lot of that is to do with the fact that the UK has got a particularly large service sector, and in particular, the sort of areas that have been hit particularly hard by restrictions is larger in the UK as a percentage of the economy than elsewhere. So, as we see an easing in sort of lockdown measures, and these service sectors has more sort of chance to grow again, that should benefit the UK relative to elsewhere. So it's a sort of a relatively sophisticated sort of version of what goes down the most, goes up the most. If you ask me specifically about manufacturing, there's not really an obvious reason why UK manufacturing should necessarily do better than manufacturing activity elsewhere.
And I guess as well, a sort of supplementary question to that is, from your broad view of the UK economy, which sectors do you think are likely to be the strongest over the next 3 years?
Sorry, James, I missed the last bit of that.
Sorry, I was just asking which sectors do you think will be the strongest over the next 3 years in terms of manufacturing?
Well, normally, normally, in a recovery, it's the more cyclical parts of manufacturing that do the best. So if you look at, what are the more cyclical parts of manufacturing, they're areas that expose that they tend to be things like, aerospace, motor vehicles, machinery production, and things like that. So historically, those are the ones that have done best in a recovery, and by and large, I would have thought they will do best this time again. Now, I suppose there are a couple of caveats to that. First of all, in particular with aerospace, which as over the last decade or so been the sort of blue ribbon for UK manufacturing. There's a couple of key questions overhanging aerospace right now. Firstly, just how quickly can the airline industry sort of recover from the huge hit it's taken during the sort of pandemic, and secondly, just how much difference will Brexit make to the situation? Will we find that, say, European customers like Airbus look elsewhere for production? So those are sort of key caveats, but in general, it is the more cyclical sectors that you'd expect to, recovery strongest. Now, in contrast, there's other bits of manufacturing like, food and beverages, which are always a solid performers, but the demand tends to vary a lot less between downturns and upturns in those sectors. So I'd expect that, the UK, food manufacturing sector to maintain a solid performance, but not necessarily to sort of rebound to the same extent as some of those other sectors.
Sure. And so based on the impact that COVID-19 has had, how long do you think it will take for the UK to recover completely? Or do you have a view onto that and the rest of the world, kind of how long it will take?
Well, I think I've got to say that's a big uncertainty, right? If you look at a lot of forecasts out there, they basically are saying that in terms of getting back to the level of activity, that we were at pre February of last year, we're looking at sometime in the first half of 2022. So that's the sort of standard forecast in terms of people expecting to get back to that level of activity. But there's tremendous uncertainties around that. That very much depends on how quickly lockdowns are eased and whether things remain under control, courtesy of the vaccine when lockdowns are eased. So assuming a fairly early easing in lockdown so that things are back, look substantially easier by the summer. Early 2022 is a realistic picture, but there's clearly things that could go wrong, so it could take a lot longer than that. Things, of course, as well vary an awful lot by sector. I've already mentioned the fact that construction activity, is slightly above where it was pre-pandemic. Manufacturing is much less below than services as well. So we could see a quicker recovery in there, and certainly UK manufacturing overall, the level of activity, could well be back to where it was in February by the second half of this year.
Sure. And then two questions we've had to come through on a financial side. So if I ask you both, they're not fully related, but obviously both relate to finance. One was, do you think the UK will hit negative interest rates? And the other one was asking about the current crisis. Do you think it'll have an effect on available lending for manufacturers?
Well, okay. Well, certainly Lloyds' official position is that they don't think that interest rates will move into negative territory. Frankly, we can't rule it out because the Bank of England isn't ruling it out. I mentioned the fact that there's a big difference between the attitude of the Bank of England and the attitude of its US equivalent. The US Fed has pretty much said they're not going to cut interest rates below zero, whereas the Bank of England is saying, it's not their preferred option right now, but they want to keep it as a policy tool. So, because they're not ruling it out, we can't rule it out. I don't personally think it's the most likely outcome. I think the economy, well, I think the economy will be strong enough to, mean that they don't have to go down that route. And secondly, I think, the bank is uncertain enough about the sort of downside risks of negative interest rates to avoid it. But, frankly, it is a possibility. And I can't say that I can completely rule that out. I forgot, what was the second question? What was the other point? James, there was negative interest rates, and what was the other one?
Yeah, the other one was, do you think the current crisis will have an
impact? Lending. Obviously, the financial sector, every sector is, being hit quite hard by, what's been going on. But on the other hand, they have been supplied by a lot of liquidity by the UK manufacturing, by the Bank of England. Now, the Lloyds position is that, we're still very much open for business, and, manufacturing is, one sector that we would definitely favour. So, I'm not responsible for lending practices, so I can't promise anybody they will get a loan from if they approach Lloyds. But, certainly, the message Lloyds want to give is that they are very much open for business. Now, in terms of, the financial sector as a whole, there clearly are issues out there, and, and a key uncertainty is whether, a movement to negative interest rates would impede, the financial economy and make it more difficult for them to lend. We'll hear a bit more about that next week when we get this update from the Bank of England, what they've heard talking to the financial sector. But overall, I would be, optimistic about the availability of lending. Nothing that's happened in this downturn, has been about the fact that, that funds aren't available for people to borrow if they want. Businesses, to the extent that borrowing, has gone down, it's clearly been because of the hit to the economy means that people are reluctant to borrow, in order to do things like invest right now. And, and clearly that's not, that's hardly a foolish position. But, I do think that, as the economy recovers, availability of funds will not be the problem that holds back business investment.
Sure. And whilst I know you obviously have a special interest with the manufacturing sector, I guess from a retail point of view, one of the questions that's come through is, with online shopping exploding because of COVID, is it safe to assume that when it's gone, online shopping becomes the main form of buying and selling? I don't know if you've got a particular view on that.
Well, I don't know about the main form of buying and selling. I showed you the sort of percent sort of chart of what's been happening to retail spending as a percentage of total spending. It's blipped up to more than 30% during the pandemic, and it is clearly going up over time. So online spending is clearly a very considerable force, and I can't see any reason to think anything other than it will grow, continue to grow over time. But obviously right now it's still less than 50%, even during the sort of the lockdown period. Now in some sectors it'll be, some parts of retailing it'll be even higher than that, but it doesn't account for the majority of retail spending. And so I wouldn't expect it to count for the majority of spending for some time yet. So things are undoubtedly very tough out there for shops and sort of high street retailers, and and that it's going to remain tough even as lockdown restrictions are eased, and so it is good. There are going to be big questions there, and I think any high street retailer also needs an internet thing as well. But I wouldn't have thought we were going to see on high street retailers, completely disappear anytime soon. It's just that, they will face just more and more competition from the internet all the time.
That's great. Thank you very much. At the moment, there are no other outstanding questions, so I will just keep an eye on it in case anyone else has any more to put in the question box. And if any pop up, I will quickly ask them. Currently, there is no one typing, so it looks like it's all been pretty much covered in your presentation. In which case, I will take the opportunity to say thank you very much, Rhys. That's been very much appreciated. And as I say, just reminder to people that this session was recorded and we will be sending that out after the event. Just a reminder that we've got one more session today at 2 o'clock, which is Professor Jürgen Meyer talking about Made Smarter. And then tomorrow you can join us for an update on Project Eli from the AMRC, Simple Steps to Automation, which is a panel discussion. And we've also got the Head of Innovation from High Speed 2 talking as well. And then on Thursday, we have Stephen Jeffers from Siemens talking about decarbonisation. If you would like to join us this afternoon, make sure you register for the session. As I say, it's at 2 o'clock. In the meantime, please check out the A to Z of exhibitors. You can start making contact with people well ahead of the physical show next April. And again, if I can just make a request, there is a feedback form that will either pop up at the end of this session and be emailed to you. If you could just take 2 minutes for that, it's really useful for us, just for feeding into the next sessions, as well as content for the show in April. So finally, Rhys, thank you very much again. Really appreciated your time today and look forward to seeing many of you later on. Many thanks.
Okay, thank you. And thanks for everybody for joining today, and hope things go well for you over the next 12 months and beyond.
Thanks, Rhys. Much appreciated. Cheers.